Today, we are featuring Bob Chapman. For those of you not familiar with Bob Chapman, quick overview. He is the editor and publisher of the International Forecaster. He's been the editor and publisher of the International Forecaster for, as long as I can remember. And he produces a couple of issues every week. I get them in my email every Wednesday and Saturday. And he takes a look at the world and brings us some information that you just don't find anywhere else. Unique insight, unique knowledge, and it's always a pleasure to welcome back Bob Chapman. Hi, Bob.
Hi there, and it's very nice to be here as well, now that all the holidays are over.
Yeah, I hope you had a good New Year, and hope you're looking forward to a good New Year.
Well, I think if you keep your wits about you, you can do pretty good.
Do you think it's going to be a solid new year for the U.S. economy?
Well, it wasn't, but up until 2 weeks ago, I figured that the U.S. economy would be a minus 1.5%. And then the Federal Reserve did a swap with the European Central Bank. And in that swap, they are going to lend. That word's not supposed to be used, but that's really what they're doing. And they're breaking their own regulations, the Fed, as well as the European Central Bank. And they're going to lend them $1 trillion. Now, that money is being given to banks. It's already started. They got $600 billion so far. And if they receive $1 trillion, the question is, are they going to use fractional banking? And if they do that, and they do it prudently, they'll be they will have at their disposal approximately $10 trillion.
That would be at about 10 to 1.
And about 9 to 1.
9 to 1. And, yeah, okay, but still, that's prudent, or are they going to consider 30 to 1 prudent?
No, historically 9 to 1, but during 2006 and 7, they get up to 70 to 1, and they're currently overall around 30 to 1 on average. And you have banks in there at 7, 8, 9, 10 to 1, and you have them in there at 50 and 60 to 1. And so, other than what I've talked about here being prudent, the numbers are far higher. And what does that mean? Well, it means that the banks don't have any problems anymore in Europe, just like they don't in the United States, because what's happened in Europe is the same thing as what happened in the United States. Money is transferred from the Federal Reserve, which creates it up out of thin air, and then it's poured into those economies via the banking system. And, of course, it's inflationary. Will they extend that? I don't know, but probably. The term on the lending by the European Central Bank to the banks within their system is 3 years at 1% interest. And that's a pretty good deal, because if you buy a 2-year Greek or Spanish bond, Italian or Spanish bond, and you get 7%, which is what the paper's selling at right now, then you can make 6% for doing nothing, and you're guaranteed a payback by the ECB.
I would like to make 6% for doing nothing. How come I don't get that deal, but they get that deal, Bob?
Well, because they're all part of a crime syndicate, and they do what they want to do, and that's given to them so that they may be successful in making some money to keep themselves from going bankrupt, because all of them are broke presently, both in Europe, the United States, and England.
Shouldn't they do something, though? I mean, shouldn't they come and wash my car or something, a little bit of appreciation? Instead, they don't do that. They just raise the fees for any banking services. They increase taxes, it seems. They increase fees for this, that, and the other. And their activities also result in in a worsening economy and higher inflation for all of us. I mean, at some point or another, don't we wake up to the fact that we're just shoveling money into the bankers' pockets here?
Well, that's what these kinds of radio programs and newsletters are about, so that people will get access to this kind of information. And that's why I do as many programs as I do. You might also add in the benefits which are being bestowed upon bankers and not upon the public. We now have a new law that says the president can have you picked up and disappeared anytime he wants. And it also said that he's not going to abide by the Constitution of the United States, on which he took his oath, and he's going to become dictator. So you can all get ready for that. And how do you stop that? How do you make things better? You elect Ron Paul as President of the United States. And he will fix those things up, or at least he'll attempt to. If we are not successful in getting people like him and he into office, then you really don't want to hear what's going to happen to you. To answer your original question, I had started off with minus 1.5%, and after they did this swap deal, I switched it to plus 1.5%, because a lot of that money that's going to go into the European banks will find its way into the British and American banks. And so that will be on top of any plus side that there would have been otherwise. And so you put all that together, and you've got a subsidy which will propel the American economy sideways this year. I would call 1.5% to 2% growth sideways. Mm-hmm. And so with that said, it's going to be a relatively, under the circumstances, good year.
Okay.
And incidentally, I am the only economist out there who's saying that, other than establishment economists. And they are basing their decisions on things totally different. They don't even know what I'm talking about.
Right.
Because they don't know how to put that into the system, plug it into the equation, if you may.
The reasoning from Abby Joseph Cohen and Byron... the reasoning from Abby Joseph Cohen and Byron Wien is far different than how you get to the conclusion that we should see a sideways, slightly positive marketplace. But how is that going to affect the marketplace? What are you looking at by a slightly positive, sideways kind of economy, a little bit of growth, maybe in the neighborhood of 1.5%? How does that equate over into the markets? And, of course, then I also want to get to how that equates to inflation.
Well, the stock market, if for no other reason, it's election year, and the person in the White House has done exactly as he was told to do. So they'll reelect him again if they can do that. And so you're not going to see any precipitous downside market, that's for sure. So the stock should trade on a Dow basis between 10,500 and 14,200 during the course of the year. And we might have a down and then an up and a down, just like we've been having for so long. And in the bond market, it'll probably stay relatively the same because it's being heavily manipulated by the U.S. Treasury. And so, if anything, interest rates might even go a little bit lower. And so, with those things said, you're going to have sort of a sideways year. As far as gold and silver are concerned, they will climb in value because they have been artificially, again, pushed downward by the Treasury Department, among others. And they did that so that they wouldn't be embarrassed with higher gold and silver prices toward the end of this last year. And, of course, they were attacking all year long from April onward. And that'll be reversed, and they'll run right back up again. And what you're being presented with here is a great opportunity to buy. And so I recommend coins, bullion, and shares. Go get them.
And the dollar, where do you see that?
I see it trading between 86 and 74, maybe 86, 88, and then 74 on the downside. It's very hard to call, even though all that money's been injected and will continue to be injected into the euro system. You still have a crisis of confidence within, say, 20, 25% of the professionals in Europe. And so what they're saying is, all they've done is put off the problem for another day, because all this money has to be supposedly paid back, and all these countries are still broke. And so you're not getting the participation in the bond markets in Europe, as I just said earlier. Italy and Spain are still paying 7%.
Mm-hmm.
And as long as that's happening, it's going to be pretty hard for nations to raise money in the bond market. France is facing perhaps 2 downgrades.
Right.
The U.S. may be facing another downgrade, and this means more to service debt cost-wise. And so I don't know that this year is going to be without problems. You have the contagion among nations and banks, and who's holding whose paper. And that's a problem. And now the Greeks appointed master of their government, Papadinos, who is a member of the Illuminati.
Mm-hmm. A technocrat who's just taken over the government, really, without democratic elections.
Correct. And he is trying to get the Greeks to issue bonds to take that money to pay off the debt. And in lieu of that, the bankers will take assets in kind, and it's never going to fly, but that's what they're trying to do. There's a good chance Greece will default in total. The game isn't over yet, and I just don't think they're going to go any further on austerity. You get people with their incomes have dropped by 50%, and that goes for retirees as well. There's signs in shops in Athens, we accept gold teeth. This is what it's gotten to.
Hang on to that.
Sure.
I think a lot's going to happen, and we'll get a better clue of what will be happening in Greece over about the next 3 months or so, early spring. But I think one of the clear things that you're saying is that there is inflation coming to the Eurozone. Consequently, there is probably also inflation coming to the United States. And that is a big implication for what we're going to be seeing as far as our investments are looking at moving forward. We're talking with Bob Chapman. Bob Chapman is the editor of the International Forecaster. You can find out more about the International Forecaster by visiting the website, theinternationalforecaster.com. theinternationalforecaster.com. You can also write an email, info@intforecaster.com. Or how about this? Give us a call, 602-324-1510.
This is Hard Money Watch with Pat Gorman on Money Radio 1510.